It's only digital gold if it has a use, and if it doesn't have a use, it's just paper. Not paper, it's air, not even air. These are the words of Eugene Fama, who has received the Nobel Memorial Prize in Economic Sciences and who believes Bitcoin will disappear within the next 10 years. While the economist Peter Schiff gives an even more radical time frame. He thinks Bitcoin will end in 2025. Hard to believe, right? Especially when Bitcoin keeps thriving and breaking its own records. But as much as we enjoy hearing praise for BTC, it's just as important to listen to those who offer a different perspective. My name is Anna and you're watching Eye of Crypto. Today we're handing the mic to the critics, the ones raising red flags about where the world of crypto might be heading. First, let's give a word to Eugene Fama, who isn't just any skeptic. He is the father of the efficient market hypothesis and a Nobel laureate in economics. And yet, he believes there's a close to 100% probability that Bitcoin will be worthless within the next decade. In a recent interview on the Capitalist podcast, Fama laid out his reasoning. Cryptocurrencies are a puzzle, he said. They break all the basic rules of what makes something good for everyday use as money. Their value isn't stable. Actually, it swings a lot. And anything that changes value that much just isn't built to last as a form of money. This critique goes straight to the heart of Bitcoin's design. Its supply is fixed. There will never be more than 21 million coins. That scarcity is supposed to create trust, but it also means the price is driven purely by demand. This results in a very high volatility. And volatility, in Fama's view, takes Bitcoin unsuitable as either money or store of value. That is why, according to him, Bitcoin is destined to go down. He did clarify that this doesn't mean it'll happen overnight. Markets are unpredictable. The crash could be sudden or it could drag out slowly. The distribution has long tails, as he put it. But if Bitcoin doesn't collapse, that's when things get really interesting. Fama admitted, half-jokingly, "I'm hoping it will bust, because if it doesn't, we'll have to start over with monetary theory." In other words, Bitcoin's persistence challenges everything economists thought they understood about money, value, and markets. Also, press like if you'd bet on Bitcoin over the economic theories that just can't explain it. Fama's doubts also extend to the technology itself. Blockchain, the digital backbone of Bitcoin, is often praised for solving trust issues. But to Fama, it's an inefficient system that consumes massive amounts of energy and one that could be corrupt if enough bad actors gain computing power. Even the one use case he sort of acknowledges, Bitcoin as a political hedge for oligarchs, isn't enough to justify its long-term survival in his view. And when it comes to regulation, Fama doesn't expect the state to stay on the sidelines forever. If crypto collapses, he believes there will be pressure on governments to step in with bailouts. That's something he strongly opposes, but he recognizes it as a political reality. If you want to avoid paying the price later, he says, you have to start thinking about it now. Fama is not the only expert who says Bitcoin lacks value. Another economist awarded the Nobel Memorial Prize in Economy, Paul Krugman, has long criticized Bitcoin as a speculative asset with no underlying fundamentals. He once called it a bubble wrapped in techno-mysticism inside a Ponzi scheme. In his view, the whole crypto ecosystem thrives on hype rather than utility. More recently, in December 2024, he published a blog post titled "Crypto is for Cryming." There he argued that cryptocurrencies like Bitcoin are primarily tools for illegal transactions, lacking legitimate use cases. Even more recently, veteran economist and longtime Bitcoin critic Peter Schiff reignited the debate with a bold statement on X. Bitcoin was born out of the financial crisis of 2008. Ironically, the financial crisis of 2025 will kill it, he wrote. Schiff's comments come on the heels of April's Black Monday. Their global markets plunged and panic spread following a sudden equity crash and a surprise 90-day tariff pause announced by the US president. In the chaos, Bitcoin tumbled over 24% from its January heights, and Schiff wasted no time pointing out the cracks. According to Schiff, if the government had instead bought gold, it would be up 2%. In Schiff's eyes, the contrast couldn't be clearer. Bitcoin is bleeding while gold is shining. And to him, that's proof that Bitcoin's era is nearing its end. Warren Buffett, one of the most well-known investors in the world, has echoed similar sentiments. He famously stated that Bitcoin has no unique value at all and compared it to delusion, emphasizing that it doesn't produce anything or generate cash flow. Here in his famous quote,
"Now, if you told me you owned all of the Bitcoin in the world and you offered it to me for $25, I wouldn't take it because what would I do with it?"
Well, it's more Bitcoins for us, I guess. Even Bill Gates has expressed deep skepticism. He once said Bitcoin is 100% based on greater fool theory, meaning people only buy it hoping someone else will pay more for it later. Well, it seems that after all of the years Bitcoin has been around, the market is still searching for the greatest fool. Or maybe, just maybe, there's a flaw in the argument that Bitcoin has no real value. One of the strongest counterpoints to such skepticism has long been the immense computing power behind Bitcoin. We're talking about global mining pools, specialized ASIC farms, and multi-billion-dollar infrastructure, all working non-stop to secure the blockchain. It's not just code and coins, it's an entire industrial ecosystem. And yet, as we give the mic to the critics, it's worth asking, is this industrialization really a sign of strength or of creeping centralization? A peer-reviewed academic paper titled "Is Decentralization Sustainable in a Bitcoin System?" dives deep into this very question. Despite Bitcoin's philosophical promise of decentralization, the study suggests that economic forces may push it toward a decentralized future. The paper shows that when miners with low operating costs also have better access to capital, they tend to dominate. Over time, this squeezes out smaller players and reduces the total number of independent miners. Instead of the centralized swarm of equal participants, we end up with a handful of mega miners, an oligopoly running what was supposed to be a democratic system. Empirical data supports this claim. As mining rewards increased and competition intensified, the number of active miners actually dropped. The competition didn't spread out, it concentrated. The authors warn that Bitcoin's decentralization could be an illusion sustained by the idea of open participation, while the reality increasingly mirrors traditional centralized systems. So, yes, Bitcoin may be backed by a massive amount of computational firepower, but if that power is concentrated in just a few hands, are we really that far from the centralized financial world Bitcoin was meant to disrupt? What do you think? Is centralization a real threat to Bitcoin or just another overblown concern? Please share your thoughts in the comments and I'd love to hear your take. If we look at the biggest mining pools today, a clear pattern emerges. Centralization is no longer a hypothetical threat, it's the reality. Just a handful of entities control the majority of Bitcoin's global hash rate. For instance, the largest pool, Foundry USA, often commands over 30% of the total network power. Combine it with a few other major pools, and you quickly approach a situation where several organizations can effectively dictate the direction of Bitcoin mining. And here's where the things get uncomfortable. When most of Bitcoin's hash rate is concentrated in large, identifiable, and often state-compliant entities, it opens the door for regulatory leverage. These pools have physical infrastructure, legal jurisdictions, and real-world pressure points. Governments don't need to attack Bitcoin directly, they can simply lean on the pools. All it takes is coordinated push to force one or more of them into cooperation. In an extreme case, a government could even attempt to coerce mining pools into supporting a hard fork. Imagine a version of Bitcoin with new rules. Rules that might allow blacklisting of certain addresses or identity link wallets. If the dominant pools are forced to support it, Users might not have much choice but to follow along, not because they agree, but because the version they want to use is no longer secured by enough miners. So, are these threats real and should we be worried? Some of them, yes. The risks critics point to, centralized mining, regulatory pressure, and lack of clear use cases, they aren't unfounded. Centralization, in particular, isn't just a philosophical concern. If enough mining power is concentrated in a few pools, it creates real-world leverage points that governments or corporations could use to influence the network. But does that mean Bitcoin will die? Well, not necessarily. It's still here, surviving legal scrutiny, market volatility, and even the criticism from Nobel Prize winners. It may not be perfect, but it's proven to be surprisingly resilient. Bitcoin's future isn't guaranteed, but it's also not easily dismissed. It exists at the intersection of technology, ideology, and economics, and that makes it both resilient and vulnerable in unexpected ways. Alright folks, that's it for today and thank you for watching. If you like this video, feel free to subscribe so that you will not miss the next one, and I'll see you there.